having trouble finding things that were interesting. But his answer made sense to me. And his answer was to buy companies that directly gave you your return. So shareholder yield. The more I thought about it, the more I thought this is the most fundamental implementation of the idea that stocks are shares of the company that there is. Actually, one of the arguments for dividends, and there's been academic research that looked at this, is that by taking away some of the excess cash that's laying around, it forces management to make better capital allocation decisions.
All right, folks, welcome to Investing for Beginners podcast. Today, we got a fun show. I have a new friend joining us today. We have TJ Terwilliger from the Compounding Dividends. He's a writer for the site and super smart guy. Obviously, we're going to talk a little bit about dividends, perhaps, and some other fun things. So, TJ, thank you very much for joining us today. I'm really looking forward to our chat today.
Dave, thanks for having me. I'm excited to be here. I'm excited to talk about dividends, and I'm looking forward to it. I think it's going to be fun.
Awesome. All right. Let's start with an easy one. So why stocks? Why do you choose to invest in stocks when you could pick real estate, crypto, any other asset class? Why stocks for you?
Yeah, that is an easy one. Thanks for starting it off with a softball.
My goal.
Answer one, I'm lazy. So I don't want to run real estate. I don't want tenants. I don't want to manage the property management company. You know, it's popular right now to kind of invest in the boring businesses. Cody Sanchez talks a lot about that. I don't want to stock vending machines. I don't want to manage people. I kind of want to invest and be hands off. And I think stocks are the best place to do that. Bonds are an option, but you know, historically the returns haven't been great. Recently, with the Fed raising interest rates, they're getting a little bit more interesting. Some of the high yield bonds are interesting. They're getting close to stock-like returns historically, but you know, in the long run, stocks have been the place to be. Crypto, I don't understand. I don't know how to value Bitcoin. I don't know what it's worth. It could be worth $1 a coin. It could be worth $1 million a coin. But if I don't understand it, I can't invest in it. I'm not a person that can say, you know, things are going up. This is the place to be. So stocks are something that I can understand. There's something that makes sense. There's something I can be pretty passive in. Once you find the right company and buy it, hopefully you can just leave it in your portfolio. So that's what led me there.
All right. That makes a lot of sense. I kind of feel the same way. I don't know if I would have described it as lazy, but that's probably a good way of putting it. You know, it's I'm letting the companies do all the heavy lifting. I just have to choose which ones to do the heavy lifting.
Yeah, I'm more than willing to do the work up front to find the right company, but once I find it, I don't want to run it. I don't want to manage it. I just want to let it do its thing, and I'll sit back and I'll collect the rewards.
Yep, exactly. All right. So do you remember your first investment?
Yes, my first investment, I started the way that most people do and probably should. My first investment was an index fund in a 401k, you know, for the employer match. That was the first one. To tell you my first individual stock that I bought, honestly, I don't remember it.
Okay. Mine, ironically, Andrew and I both bought Microsoft in 2014, which
Okay.
was kind of funny. I mean, you know, I backed up the truck. I bought one whole share at $34 a share. So I still own it. So that's awesome. But you know, hindsight is 2020. I should have dropped a cool 10,000 into it. But you know, hey.
Yes, yeah. Google was one of my early ones. I don't remember. I don't think it was number one, but it was early, and it was on one of the regulatory scares. You know, Google's going to get broken up as a monopoly.
Right.
Pre-split, I do still hold it. Same mistake. I should have bought a lot more, but there's definitely some early ones that I remember that weren't winners as
Yeah,
well.
So, I had a few of those too. For sure. So I guess why dividends? Like we have this wide universe of things that we can invest in. What about dividends is attractive to you?
Yeah. So I didn't start that way. I didn't start as a dividend investor. My beginnings were kind of in the classic Ben Graham, Warren Buffett value style. So I remember reading the red 2006 version of The Intelligent Investor, sitting on the bed in a hospital room after after my son was born. So, holding the newborn baby in one hand and Ben Graham in the other. Uh, and went through that whole kind of classical canon, the most important thing, and the PDF of Margin of Safety, and, the Dondo Investor by Manish Gabrai, and
Mm.
Joel Greenblatt's books. So that's where I started. And the CAPE ratio at the time was, probably 20. We were coming out of the great financial crisis. It was, 2010, 11, somewhere in there. And so that style made total sense to me, that you find something that's priced for less than it's worth and you buy it on sale. I grew up with a mother that loved a good sale. She was one of those people that she would take the receipt back in and say, "Hey, you overcharged me by $1," and she'd get her dollar back. So that was instilled in me from childhood. So it made total sense. And when I went off to look for bargains, the market pretty much has gone up since to where we are today. And as that happened, it started to make not value investing, but the market itself started to make less and less sense to me. So one of the other ideas that came from Charlie Munger is the idea of finding the 1 foot bar to step over, not the 6 foot hurdle. And as values kept climbing, the 1 foot bars became harder and harder to find. Manish Gabrai talked about no-brainer investments, the ones that don't have a lot of downside. You look at it and you go, yeah, that's obviously cheap. And there's been a few of those along the way, but you're not going to get that many of those in a year. So if you get 1 or 2 a year and you want a really concentrated portfolio of, say, 10 stocks, that's 5 to 10 years to get fully invested. That's a lot of time to not be compounding.
Mm-hmm.
And we know, time is the most powerful component in that compounding formula. That's the exponent, right? That's what does most of the work. So not being invested wasn't really a great choice, but I was having trouble finding things that were interesting. And what really led me towards the dividend path, I was looking this direction to start with. I'd started looking at some cannibal companies, at buybacks, that sort of thing. But what really got me on that path was David Einhorn wrote some letters. He came out with his theory that passive investing is broken the markets. I don't know that that's necessarily the case. We can talk about that if you want to. But his answer made sense to me. And his answer was to buy companies that directly gave you your returns. So shareholder yield, either buybacks, paying down debt, or dividends. And that really also kind of clicked with me. Just like the finding the no-brainers, the value investing, that idea made total sense. If the market doesn't make sense to me, why not try and cut it out and get the return directly from the company? And the more I thought about it, the more I thought this is the most fundamental implementation of the idea that stocks are shares of the company that there is, right? If I buy a stock and I become a part owner, why would I not want that company to share some of the profits with me? Why would I not want to benefit from the growth and the profit? So that's kind of the journey of how I got there.
I mean, I totally agree. The company is, creating cash from its profits, and it has choices to what it wants to do with that cash. And part of the choice is paying a dividend. And I think a lot of people, especially with the markets being the way they have been the last few years, is that everybody's focused on growth, but they don't realize that 8 to 10, 7 to 9, whatever number you want to put on the market returns over the last 100 years, 2 to 3% of that is dividends. You take those away and that's the market hasn't returned that great. I think dividends should be a definite part of somebody's portfolio. Absolutely.
Yeah, I mean, the other interesting point there is that if you look at total return and you look at reinvesting your dividends and you take a good period, like 20 years, you'll find that around half of the total return comes from the dividends and the reinvestment. So if you ignore that component, you potentially leave, a lot of return on the table, especially when you're looking at it from a market perspective.
Right, exactly. So can you explain that concept of a drip, of reinvesting the dividends and how that works?
Yeah, absolutely. So when you get paid a dividend, it's just a cash payment typically. straight from the company. So they take part of the profits and they share it with you as a shareholder. And then you have choices on what you want to do with your cash. So one, you can just take it and spend it on whatever you want. You can let it accumulate in whatever your sweep account is in your brokerage account, or you can reinvest it. And some companies do have a direct reinvestment plan that you can enroll in. The advantage to those is that you don't actually get the cash. They reinvest it for you. And that, depending on the drip plan, depending on where you live, can save you on taxes. If the company won't do it directly, most brokers will give you the option that once that cash rolls in, they'll go ahead and reinvest it for you and buy whatever, it's usually a partial share, unless you own a lot. But over time, you basically reinvest those dividends into the company and you own more and more. And you can think of that compounding the same way that a company reinvesting in itself does. You own more of the company, the next dividend, you get a little bit more because you own more of the company and you reinvest that back in. And over, a good period, like I said, 10, 20 years, you can end up owning significantly more of the company and having a pretty nice dividend payment.
Yeah, for sure. I use Fidelity, and I know that they allow to automatically reinvest the money. I've had a few times where I bought a new company that paid a dividend, and I missed that little trick. And then I started noticing like these little incremental amounts of cash building up in my account. I'm like, what's this company?
Yeah.
And I missed the automatic drip, which is it's a modern marvel that I don't think is talked about enough.
Yeah, it's really nice. It's a really nice feature. You don't think about it. Now, some investors do turn that off, and if you're really tracking your dividends and paying attention to when they come in, what some people like to do is to let the payments build up for the quarter or the year or whatever, and then they want to pick the company that they think is the most undervalued and reinvest there. If you're really on top of things and you're really paying attention, you're really tracking those dividends, that can work. But I think for most investors, honestly, just letting your brokerage or letting the company do it for you automatically is probably the way to go.
Yeah.
Whatever you sacrifice in return because you bought a little more expensive share probably comes out in the wash, whenever you look at the compounding over decades.
Right. Yep. Totally agree. So if you were a newer investor and somebody, if a newer investor came to you and said, I would like to start investing in dividends, where would they start?
So the easiest place to be, especially if you're a US investor, is there are ETFs that are focused on dividends. So you can look, if you don't want to do the work of figuring out individual companies, you can look right at an ETF. So Vanguard has a high yield ETF. They've got one that focuses on dividend yield plus stability. You can buy ETFs that track some of the dividend indexes. So there's dividend aristocrats that have paid 25 years of dividends, or what's 25 years of dividend raises in a row. There's ETFs that track that. One of the more popular ones is the Schwab Dividend Fund. It's SCHD is the ticker. That one runs on an algorithm. It rebalances I don't know, honestly, the schedule, if it's quarterly or yearly, but it's got a pretty good track record. I mean, it's over a 3% yield, and I think it's grown the dividend about 10% a year. So looking into ETFs is the easiest place to start if you want to add some dividends to your portfolio.
Yeah, that's great advice. Now, let's say I want to be different. I want to pick my own companies. I don't want some algorithm picking them for me. Then where do you go?
Yeah, so I think picking a dividend paying company is no different than picking any other company, assuming you're a fundamental investor. So what I mean by that is you're going to look at the financials, you're going to look at the profits, and you're going to say, what's this company worth? If you're gonna do it based on technicals and look at charts, I'm not your guy to answer that. But like I said, not my expertise. I know some of it, but I don't invest that way, so I can't help you. But I think honestly, because when you buy a dividend paying company, I think it's the most fundamental application of you're an owner, right? Like Buffett and Ben Graham have told us for years that shares aren't ticker symbols. They're not lines that go up and down. They're not there to be traded. They're ownership shares of the company. And when you buy a company that pays you a dividend, that really does make you an owner. You're going to get a payment out of the profits. So that's number one. You want to make sure it's profitable. So I think about honestly buying a dividend paying company the same way think about buying a company down the street, the local coffee shop or whatever. Pick your business that has the line out the door that does a bunch of cash and you'd love to own a piece of. Maybe your
Mhm.
dentist's office. I think about buying a dividend company the same way. So it's something that's been profitable in the past. We want to own it for a long time. So it's something that's going to be profitable in the future. We want some kind of moat. We want some kind of advantage that they have. We want good management to run it. Like I said at the beginning, I'm lazy. I don't want to go in there and make decisions. And we want that management to be shareholder friendly. So we want to look at the dividend history. So basically, kind of what that means is I'm going to go in, I'm going to look at the financial statements. I want to see some growth in revenue. I want to see some growth in profits. I want to see a good decisions by management. I don't want to see terrible acquisitions or attempts to grow into areas that they have no business being in that fail. And I want to see a consistent dividend history. I want to see that they've paid one for a while. Preferably, it goes up on a reasonable basis. I don't necessarily need an increase every single year, but I want that line to generally be trending up. I want a balance sheet that's going to let them continue to pay out a dividend. I don't want so much debt that that's going to squeeze the extra profits. And I want to see that the dividend payout ratio is sustainable. So that's a metric that is pretty easy to calculate. Generally, it's just your dividend per share divided by your earnings per share. And what that's going to tell you is how much of their profits are they paying you as a dividend. A company that pays 70 or 80% of their profits as a dividend doesn't have as much room to grow as a company that's paying you 30 or 40%. So that's kind of the basics of how I would look at it.
Yeah, and those are all great frameworks to buy any company, but also dividend paying companies. You mentioned payout ratio. Let's maybe talk about a few ratios or metrics that people could use to kind of measure dividends. And I guess what would be the first couple that you would look at?
So payout ratio is definitely going to be one of them.
Mhm.
I'm gonna look and see how much are they paying out in profits. Now, depending on the company, the way you want to calculate that can vary. So you can look at earnings per share. That's the metric that's going to come up on most of your brokerage accounts, most of your financial sites. But alternative ways to calculate that, you can use free cash flow. So you can use the dividend payment as a percentage of free cash flow. Sometimes if you have earnings that look a little funny because of maybe one-time charges or non-cash charges, that can be an interesting way. Earnings can be kind of manipulated by the accountants. Free cash flow is harder to. And then depending on the company, you may want to look at some different ratios. So like in a REIT, you're not going to look at earnings per share
Mhm.
versus dividend payments because of the structure there. They use a different metric called FFO, funds from operations. Essentially, it's the free cash flow of a REIT, and that's the payment ratio you want to look at for them. You want to look at the dividend yield. So that's your dividend per share divided by your stock price. And that's going to tell you essentially just like a bond yield would. If you pay X dollars for this stock, you're going to get such and such a percentage back of the dividend. That's your starting dividend yield. So that's definitely an important metric for a dividend investor. Those are your two biggest to start with. And then beyond that, it's most of the financial ratios that you're going to look at as a fundamental investor. So you're going to look at growth rates and, like I said, earnings. You're going to look at the growth rates and revenue. You probably want to look at some of the balance sheet ratios to make sure that, like I said, there's enough cash flow there. So the quick one that most of the credit agencies use is debt to equity.
Mhm.
But some companies, especially your older dividend paying companies, if they pay out a lot to shareholders and if they buy back a lot of shares, sometimes you get negative equity. So that's not always the best balance sheet metric. I tend to look at things like, interest coverage ratios, how much cash flow do they have versus their interest payments. I like to look at a free cash flow to net debt. So that tells me how long it would take them to pay the debt off. If they decided to run the cash flow in, those kind of metrics can be useful in figuring out does this company have the cash flow to keep paying me a dividend or are they going to cut it?
Yeah, that's kind of important, huh?
Yeah.
Yeah. So Let's maybe talk about a couple red flags. If you are looking at the payout ratio and the dividend yield, for example, are there any numbers that you come across that you'd be like, okay, this is a red flag?
Yeah. So very, very high yields can be a red flag. They can also be an indicator either just that the company's very mature and pays out a lot in dividends, or occasionally that it's a good bargain, that the company's really cheap, because that's one way to get the dividend yield up is for the price to go down, right?
Right.
So, rule of thumb, anything over 8% a lot of the time kind of raises a red flag to me to just look a little closer. On the payout ratio, it really depends on the yield. So a high yielding company, something like, Altria is a good example of a high yielding company. That's previously Philip Morris. They make cigarettes. That's Marlboro,
Mm.
Skoal. They tend to pay about an 8% dividend, and their dividend payout ratio is about 70%. In that case, that's fairly normal, right? That's a pretty mature company. They don't have to
Mhm.
reinvest a lot into growth. They're not building new plants. They're just going to keep selling cigarettes and chewing tobacco. So in that case, that's fine. A younger company, one that's growing faster, I like to see a payout ratio somewhere around 50, 60% or less. And again, that depends on the initial yield, that depends on the growth of the company, that depends on how much do they have, how much room do they have to reinvest and grow, kind of where are they in the company life cycle. But for a high yield company, under 70% for a payout ratio. For a dividend growth company, anything 50, 60% or lower is okay with me. Above that, I'm going to look closer.
Yeah, yeah. I prior to the GameStop meme thing, that was one of the companies made a mistake and invested in, and part of the attraction, especially for value investors back then, was it was an 8 to 10, 12% yield, mostly because the stock price was dropping so much. And I remember people like, oh, GameStop is a great play, and yeah, it wasn't. So it's always good to understand the pros and the cons when you're looking at different metrics, so you don't get you don't drink the Kool-Aid too much and get too excited.
Yeah, sometimes chasing high yields is a mistake, but sometimes, like I said, sometimes it can be a bargain, and sometimes it's just something that the market is ignoring. Right now, European companies are really ignored. Some of
Mhm.
them are yielding fairly high yields, and there's some good companies there that just aren't getting a lot of investment. So it can be okay.
Yeah.
Did you get pulled into GameStop with Michael Burry?
No, I actually,
Yeah.
no, it was just me and using FinBiz screeners, and it kept coming up. It kept coming up. And then I started doing some research, and I just, I thought that maybe what they're going to try to do with collectibles and things like that would be an opportunity for them to turn around the business. And I was wrong. So, and the high dividend yield was part of the attraction.
Yeah, that was one that came up on some of my screeners, and when
Mhm.
Burry bought it, it was on my list to research, and I started it, I looked at it, and I never really got deep enough into it to convince myself to do it. So I missed it, but I could have been right there with you, and it is a
Yeah.
shareholder.
Yeah. Former bag holder here. So,
Yeah.
um, yeah, it's always interesting to look back on some of your previous mistakes and, okay, what did I learn from this? So you kind of mentioned dividend aristocrats. And so that's something that I think we could probably maybe chat a little bit about. So I guess, first of all, maybe can you help define what they are?
Yeah. So the dividend aristocrats, it's a list of stocks. There's a few requirements for them. They have to be included in the S&P 500 to be an aristocrat. Depending on who makes the list, there's usually some kind of liquidity requirement, but typically, when you're included in the S&P 500, they clear that one. The other requirement is that they've paid an increasing dividend for at least 25 years in a row. I think, I shouldn't guess, but I think there's around 66 companies on that list right now. But there's a few others that you can look at if you're looking at lists of, good dividend payers. Dividend kings have paid dividends for 50 years or more.
Mm.
So that's an interesting list. There are lists of companies that have paid dividends but are not included in the S&P 500. So you've got dividend champions. Those don't have the S&P 500 requirements. Those don't have liquidity requirements. So that can be an interesting list as well, because you can find some small cap companies. You can find some companies that aren't in the index that have a good dividend history in some of those lists as well. So those are good places to start, especially like you asked, if you're a starting investor and want to pick your own companies, you're getting a good dividend history there at least.
Yeah, for sure. And the thing that a lot of newer investors maybe don't realize is when a company makes a decision to start paying a dividend, they don't do it lightly, because when the market sees a company stop paying a dividend or cut a dividend, the market does not like that. And the companies take a big hit. I remember when Disney, you know, stopped paying a dividend. Obviously, it was because they had no revenue from the pandemic, but still, the market kind of spanked it pretty hard because of that.
Yeah, that's one thing that, there's a theory that dividends are a signal to the market from management. And it's exactly for the reason you mentioned. When management pays a dividend, when they start a dividend, that's usually a long-term commitment. Once you start paying a dividend, shareholders expect it to keep coming, unless you say this is a special one-time dividend. We sold this division of the company and we've got this giant cash fall and we're going to pay out, some percentage of it as a special dividend. But once you start paying that quarterly dividend, that's a long-term commitment to shareholders. And like you said, one of the last things management wants to do is cut that dividend. That's a big signal to the market, and it's not a good one. It says, we don't have enough cash to pay you our dividend now, and we don't think we're going to have it next year, and we don't think we're going to have it the year after that. We're going to cut it.
Yeah, I guess I'm curious, when you're searching for potential investments, is an area like the Dividend Aristocrats or the Kings, is that a place that you go to mine first, or like where do you kind of look when you're looking around trying to find companies?
Compounding dividends, we have an investable universe. It's over 800 companies.
Only 800?
Yeah, well, there's 30,000 stocks in the world. We're global. We don't just look. We don't just
Only
look US
800.
stocks. But we split it into three buckets to make it a little bit more manageable. So one is our dividend growth bucket, and essentially those are companies that have grown the dividend 10 years or more. And so that includes your aristocrats, that includes your kings. The dividend champions that I mentioned earlier, those are your 25 years or more, no index requirement, no liquidity. And then the contenders are the list that is 10 to 24 years of dividend growth. So that's pretty much what makes up that list. There is our high yield universe. That's anything over a 4% yield. And then we also look at our cannibal bucket. So those companies do not actually have to pay a dividend. Oh, some of them do. But those are companies that have a nice history of buying back shares. So you can think of, your AutoZones, Domino's Pizza's bought back a lot of shares over the years. Those type of companies are in that bucket. So those have all been screened and developed. So that's where I tend to hunt. But for someone that does not have access to that, yeah, the aristocrats, the contenders, the champions, pick your list. That's a great place to start.
Yeah, I agree. Let's talk, if we could, let's talk a little bit about, you kind of mentioned cannibals, and you and I were talking off air about, Meb Faber and Jim O'Shaughnessy talking about shareholder yield.
Yeah.
Maybe you could explain a little bit about what that really is and how you use that for your investments.
Yeah, so this is one of my favorites. Shareholder yield is a combination, typically as your dividend yield plus your buyback yield plus the yield from debt pay down. And those three components added together make up what's called shareholder yield. And the reason for that is, if you think about management, when they make a profit, they have some options. Basically you can reinvest in the company, right? You can grow it. You can maybe acquire another company. You can pay down debt, or you can keep it on the balance sheet and just let the cash sit there and build up, or you can share it with the shareholders. And those three ways really are the ways the cash either directly or indirectly gets back to shareholders. So the dividend payment is easy. That's a direct payment right to you. Share buybacks are a way to give you more ownership of the company. So every time the shares shrink, your shares that you own become worth more of the company. And then debt pay down, you can think of the same way you would think of it as if you were paying off, credit card or auto loan debt. When you pay that debt off, you don't have to make that payment next month. So then the earnings of the company are going to go up, and then you can get more either through your share buybacks or your dividend yield.
Yeah.
The really interesting thing, and the reason I like the shareholder yield metric so much, is one, you mentioned that dividends are a long-term commitment. So management wants to be a little cautious with those, right? They want to set it at a target where even in kind of a bad year or bad couple years, that they're going to be able to keep paying that dividend. They don't want to get it cut. So they tend to be a little bit conservative on that. Buybacks are flexible, right? So the board approves such and such a number. We're going to approve 3 billion in buybacks or whatever number they approve, but management gets to decide when those shares get bought back and how many. So some buybacks just basically mop up share-based compensation. They issue so many shares with one hand and they buy
Meta.
them back with the other.
Meta.
There's a few that are that way. So buybacks can be used basically to mop up the share-based compensation and kind of hide that. That's not overly value creative. I would argue it's not my favorite way to do it. Honestly, I would rather them just pay the bonuses out in cash or whatever and not play the buyback game. But assuming the company is actually reducing the number of shares and doing so at a reasonable valuation, that can be very, very beneficial to shareholders. If you have really good management that pays attention and waits and buys back shares at cheap valuations, you can do very, very well there. And then, of course, the debt pay down, if they've got high yield debt, if they've got expensive debt to pay that off, that can raise your earnings and open up more cash for dividends and payments back to you. The other interesting piece is that, a lot of people get worried about taxes on dividends. That's not something necessarily I discuss all the time because it's so dependent on what account do you hold the dividend in, the dividend payer in, where do you live, where's the company based, because those are all going to affect taxes. But typically buybacks are more tax efficient because you never receive that payment. So you don't get a tax, on the dividend, on the income, however that's taxed. So a little bit more of that comes back to you. So that shareholder yield, it saves you on some taxes and it lets management, if they're good, really drive some value for you.
Yeah, exactly. I look at FinChat they calculate shareholder yield, which is nice. So you can look at it quickly without having to do all the heavy lifting of figuring it out. It's good to look at it to see how those interact. Some companies, like you said, AutoZone and O'Reilly and Home Depot, they're all big share cannibals, but they also pay dividends. Well, does Home Depot pay a dividend? Yeah, they do.
Yeah.
But one thing that surprised me years ago, I was looking at Johnson & Johnson, and they're obviously famous for being a dividend aristocrat, and they actually pay out more. They spend more on buybacks than they do on dividends, which kind of surprised me. And that was kind of my first introduction to this like whole advantage of buying back shares. Like, oh, hey, this could actually be a big thing. So I guess, what are your thoughts on companies that you mentioned the negative equity. So a company like Starbucks and Home Depot, I believe, are both negative shareholder equity. How do you feel about that as like a dividend paying company? Is that something that concerns you, or is it just kind of a nothing burger?
It really depends on the company. It really depends on the reason for the negative equity. Like I said, sometimes you see that, especially in companies that do return a lot of capital to their shareholders. The other thing sometimes you see that in is companies that don't have a lot of physical assets. So think about McDonald's owns most of their real estate, so that goes on the balance sheet. But a franchise company like a Domino's Pizza won't own the majority of the restaurants. So the land, the buildings, the equipment, none of that's on the balance sheet. And when they pay dividends and buy back shares, that puts their equity negative. So like I said, you have to dig in and understand the reason that the equity is negative.
Yeah, that's a good point. I guess kind of on the flip side of that, how do you feel about companies that borrow to pay dividends?
Typically, I would say that that's a bad idea. One that famously did that was Boeing. They If you look at charts for Boeing, you can see the dividends going up. And if you chart the long-term debt alongside it, it goes up right along with the dividend. And then, of course, eventually they cut the dividend way down and then they stop paying one altogether. So it's typically a bad sign. I really prefer to see the dividend coming from earnings. Would I say that I would absolutely never, ever, ever invest in a company that did that? I hate to say never, period. I guess I could see maybe a situation where during, the zero interest rates where it was a better idea to invest in this thing for growth and then borrow a little bit to pay the dividend because the yield on the growth was going to be so high and the debt was so cheap. A little bit of financial engineering, but I would be really, really cautious, and that would make me really look hard at management. That's not a strategy that I love to see.
No.
Most of the time, if they're borrowing to pay the dividend, that's a bad sign. GM did it for quite some time before they got bailed out. Like I said, Boeing more recently. I honestly don't know of any cases where that was done and it turned out well.
Right. Yeah.
And
Yeah.
like I said, that doesn't mean it didn't happen. That doesn't mean somebody didn't take really cheap debt whenever money was basically free and take advantage of it. But I would be hard pressed to think that that's a good sign.
Yeah. Yeah. Me too.
My recommendation, our free ebook and email series at stockmarketpdf.com.
I remember a few years ago, might have been during the pandemic or prior to that, that I think it was Exxon or Chevron was kind of on the struggle bus. And I know that they were borrowing some money to pay the dividend because they didn't have the cash flow because of oil prices were all over the place. When you're thinking about companies like that, does that play into how you're evaluating them because they're commodity-based business, and so there's going to be wild fluctuations in what goes on with them?
Yeah, so in that case, I mean that's an odd case. When oil prices are negative, that's something I don't think anybody's ever seen before.
Bingo card.
No, I wouldn't have predicted that. So in that sort of case, yeah, to borrow to cover because commodity prices have crashed. You sit there and you look and you go, in 2 years, is oil still going to be negative? No, there's no way. So in that case, yeah, that's probably a safe bet, especially in something like an Exxon or a Chevron. And if you look at those companies, honestly, I don't know Exxon as well. I know Chevron fairly well. Chevron's got a pretty solid balance sheet at this point.
Yeah, for sure.
And I think Exxon does as well. So those large companies like that, like I said, for a weird one-time event to borrow, yeah, that's fine. That's probably a smarter move than cutting the dividend. Like you said, that's a massive signal to the market. Your stock's going to sell off. Your cost of equity is going to go way up. That creates more problems than taking on some debt until oil prices recover and you pay it off.
Yeah, very good point. Very good point. Are there any sectors or asset classes, I guess, that are more favorable to dividends than others?
Yeah. So traditionally, there are certain sectors that tend to pay more out in dividends. You already mentioned one was energy.
Mhm.
Your bigger, mature industries tend to pay more in dividends. So think things like utilities, some of your like cable companies. And then as far as asset classes, we already talked a little bit about REITs, that's a real estate investment trust. They're actually required to pay out 90% of their profits as dividends for tax reasons. That's based on the structure. So REITs are always a heavy dividend paying asset class. There's another structure called a master limited partnership, very similar to a REIT. They're required to distribute, they don't technically pay a dividend, they distribute cash to limited partners. But that's common in, think like your pipeline companies. So your companies that run pipelines to transport oil or gas, that's your most common MLP structure. And they tend to be pretty heavy dividend payers as well.
Is the tech industry traditionally much in dividends at this point?
Traditionally, no, but some, when you think your Magnificent Seven, they're starting to pay out some dividends. It's not heavy, it's not a lot, but Google's got a dividend going, Meta's got a dividend going, Apple's been paying a dividend for quite some time. I don't know, some of the listeners that have been around a while might remember Apple had a lot of shareholder rabble about building up a bunch of cash on the
Mhm.
balance sheet. Carl Icahn maybe was the one that got in there. There
Yeah,
was an
probably.
activist investor.
Yeah,
Yeah,
probably.
I think they had over like $1 trillion of cash sitting on the balance sheet, and the investors got upset and they said, "Hey, you should be sharing this." So that's kind of when Apple initiated the dividend. They've been paying the dividend longest. Nvidia pays a dividend.
Mhm.
Nvidia actually is buying back shares, which kind of baffles me as far as valuation of the business and capital allocation goes. But they're buying back shares. Tesla, I do not believe, pays a dividend, and Amazon does not. But if Amazon initiated a dividend, it wouldn't shock me either at this point.
Mhm. No, no. And I think a lot of people, when they think about dividends, we talked about this off air, is they think of it as kind of a fuddy-duddy. It has that stereotype of a fuddy-duddy, but then you throw out something like Nvidia, which everybody thinks is a brand new company. It's really been around for like 25 years. Let's touch on that. If somebody comes to you and say, "Yeah, dividends are boring," I want to invest in tech. I want to be exciting. Well, what's your counter to that, sir?
Well, first of all, I would say if you're investing for excitement, that's probably the wrong reason. If you want to take some money that you can afford to lose and gamble it and invest in, MicroStrategy, or pick your flavor of the week. If you want to ride the GameStop roller coaster or buy an NFT in 2021, that's okay with me. But as far as long-term investing goes, I'm of the opinion that it should be boring. I don't want, my life savings going up and down 20% every year. I would prefer, 10% for 20 years in a row. So that would be point number one. Point number two is the idea that, so let me back up a sec. So one of the reasons I think people get down on dividends is they say that, that's money that can be reinvested back in the business. That's money that could grow the business, right? But when you look at some of these companies, where are they going to reinvest? What's Google going to do, with the profit it makes? What's Nvidia going to do with the profit it makes? You can only reinvest so much cash in things that have a high return. And then the question beyond that becomes, what do you want management to do with it?
Mhm.
And actually, one of the arguments for dividends, and there's been academic research that's looked at this, is that by taking away some of the excess cash that's laying around, it forces management to make better capital allocation decisions. So if you don't have $1 trillion on the balance sheet like Apple did, that you don't have anything to reinvest it in, you're much less likely to buy a new corporate jet, right? You're much less likely to acquire some company that really doesn't add anything. You're much less likely to try and build an empire. And the other thing that does is it forces sometimes for expansion and for those ideas that management has, it makes them go to the capital markets, to either raise equity or to take on some debt. And when that happens, there's a lot more scrutiny of the company and of the management. So again, that's one of those forcing functions to make them make better decisions instead of wasting capital. So that's one thing. And number two is that the market we've had, I touched on it earlier, that some of the things that are going on in the markets don't really make sense to me at this point. And when you look at what's going on essentially since 2009 to today versus historical, it's odd. It
Yeah.
doesn't look like the past. So historically, dividends have been, like I said, a big component, up close to half of your total return. So if you intentionally avoid them, assuming that the market doesn't go up the way that it has forever, you're probably giving up some potential return. And we talked about it offline a little bit. You threw out 7, 9%, 10%, whatever, pick your historical market return over the long run. We've had 20% recently, for quite some time. So if you think that the long-term return is going to be that 7, 9, 10%, then there's either a lot of sideways trading coming, or at some point there's a big drawdown. And in both those instances, dividends are a big component of your return. So whenever the market draws down and your stock prices are lower, your dividend return is always positive. Your total return might
Mhm.
not be. But if your portfolio's got a 5% dividend yield, that's 5% that you're getting, and it comes off the negative yield. And if you're reinvesting, assuming those companies come back, you're just buying more shares of that company cheaper
Mhm.
on the way down. when it recovers, that dividend payment's going to go up, and so does the stock price. So it may not be the most exciting way to invest, but I think, historically it's worked. Historically, companies that have grown their dividends have outperformed the S&P, and companies that don't pay a dividend, and especially companies that cut the dividends, it adds some stability to the portfolio. It kind of takes away some of those market effects.
Yeah, yeah, for sure. And if you look back at even just the last 20, 30 years of the market, if you break it into 5 or 10 year, components, the top 5 or top 10 companies from 20 years ago are not the same that they are today. And history tells us that in the next 20 years, those probably won't be the same that we're seeing today. There may be a few, but not all of them. And so the markets will change. And as those companies evolve and grow, they have, as you said, allocation decisions to make. And I think our whole discussion today, to me, really indicates how important what a company does with the money that they make, and how important those capital allocation decisions really are. And I think, the more you can figure that out and find the best capital allocators, the better your returns are going to be over the longer run.
Yeah, absolutely. I think management is important no
Mhm.
matter what type of investing you're doing.
Mhm.
But if you're looking at dividend paying companies, they're really important, because those are the guys that are going to decide, or gals, that are going to decide how much they're paying out. Are they going to continue to pay out dividends? Are they going to buy back shares? Those are the people that drive your shareholder return. And no matter what the market does, like you said, it's definitely uncertain. Top 10 companies changed. Which country does the best changes? There's been periods Japan outperformed the US for a long time. International stocks have outperformed, small caps have outperformed. What does the best, varies from year to year, decade to decade. But one of the things about dividend investing for me is that I just can't think of a reason that it's a bad idea to own a company that generates a lot of cash and shares some of it with me.
Right. Yeah. I mean, I think that last little sentence I think you said is something that's really important for people to understand. Companies that pay dividends are generating a ton of cash. Companies that don't generate a ton of cash can't pay a dividend. And and you want companies that are generating a lot of cash, because it gives them optionality. It gives them options, choices to make of what to do with that money. And you may think of Coca-Cola as, a boring company, but the fact of the matter is it makes a lot of money, and it pays a nice dividend because it makes a lot of money. And those are the companies we all want to find, is there's cash flow in companies. So another question I think is kind of interesting to explore is, what are your thoughts on Buffett? So he loves dividends, but he doesn't want to pay one, and he hasn't paid one, and he unlikely will before he leaves the company. So what are your thoughts on that?
Yeah, that's a good question. Buffett's interesting in this regard. And I just reread The Intelligent Investor. It came out with a new editions. Jason Zweig did new commentary. It's worth it for his new commentary. It's really interesting. But when you read Ben Graham and you read The Intelligent Investor, there's a pretty big focus on dividends there. And you think about, the companies in the stock market in his day, most of the companies paid a dividend. It was
Mhm.
expected. You were an owner of the company and you deserved, your share. And when you look at Buffett's top holdings, all of them pay dividends. I mean,
Yeah,
he's selling down Apple, but Apple was
still
a big
pays a
holding
dividend.
for a long time as a dividend payer. Bank of America was a big holder. It's a dividend
Mhm.
payer. He owns a lot of Chevron, dividend payer. Coca-Cola, as you mentioned, dividend payer.
American
So
Express.
American Express is a big one, dividend payer. He bought a bunch of Chubb Limited recently. That's a dividend
Mhm.
payer. That's an insurance company. What else? They bought All the Beauty for a little bit and sold it. That's not a
Mhm.
dividend payer, but that's a buyback company. Domino's Pizza was a recent acquisition. That's a
Mhm.
buyback company and they pay a dividend. Occidental Petroleum pays small dividend, but they buy back a bunch of shares. So Buffett really seems to like this shareholder yield model. When you look at what he does and what he holds, he really does seem to like it. And, we talked about capital allocation and management. I have a hard time arguing that when you have the best capital allocator in the world running the company, that I'm going to do a better job with the capital than he is. Berkshire not paying a dividend and building up the cash is kind of okay in my book. Because like I said, that's the best capital allocator in the world. Management I trust, like nobody else. So to let Buffett build up a bunch of cash and hope that, something interesting comes along before, he passes away, I don't have an issue with that. I suspect that, when Buffett's gone, that Berkshire probably will become a dividend paying company.
Mhm.
But I don't think, some people look at that as a contradiction, and Buffett's written pretty extensively about it. As long as you can generate more than $1 for every dollar you keep in the company, then that's a good decision. Given his track record, I think Buffett deserves a lot of leeway. I trust him to generate more than $1 for everything he's keeping.
Yeah, for sure. For sure. So I guess speaking of that, do you own companies in your portfolio that do not pay a dividend? I do. Berkshire Hathaway being obviously the prime number one.
Yeah, I do. So it's not the only way that I invest. I do own Berkshire, and I do own some other non-dividend paying companies. So like I said earlier, whenever I kind of talked about my road to dividends and shareholder yield, the other piece that really makes sense to me is that, no brainer, like something is going on with this company and the market is way mispricing it. I'm more than happy to take advantage of those.
Mm-hmm.
So I do own some of those types of companies that I've had along the way. Probably most recently, to give you an example, Netflix, whenever it dropped under $200 a share, and I think it was 2022.
Yep.
Because they lost a few subscribers coming off the pandemic, and the market went good. Netflix is over.
It's done.
It crashed. Yeah,
he's gonna win.
That's one of those ones I bought, and I should have bought a lot more. But still hold Netflix, and part of it even goes back to kind of this shareholder yield cash flowing mentality. At that time, and still, it's only the second. I think there's two streamers that actually make money at this point. Disney Plus just became profitable.
Right.
But at the time, Netflix was the only streamer that actually had positive cash flow. They had a pile of subscribers. The data they have is unbelievable. They know what you want to watch before you do. And they use that data to make shows that'll be hits. Whenever it dropped that cheap, I went, I got to buy some of this.
Yeah.
That's, those kind of things I will take advantage of. I do still like the quality companies, like the compounding quality philosophy. I own some of the companies that are in that portfolio. I haven't bought every single one of them. There's been a few that Peter will pay a higher price than I will. I'm still a cheapskate at heart. So there's still some of those that have been a little pricey for me that I don't own. But I do have some of those quality companies in my portfolio, and I do have some of those that were no-brainers that just got way too cheap.
Yeah. Yeah. You got to take advantage when the market, when Mr. Market offers you a deal. Sometimes you gotta take advantage when you can.
Yeah. So I'm not a dividend purist. I'm not you have to pay a dividend for me to be interested. But I think especially right now, that's a very interesting way to invest. I think it's defensive. I think it protects you against whatever unknowns are coming in the market. And since growth is such a focus at this point, I think a lot of these dividend payers are underpriced compared to the rest of the market.
Yep, I totally agree. Well, TJ, this has been a lot of fun. I've learned a lot today, and you made me think about some things differently that maybe I had kind of thought about. So where can people find more about what you got going on and what you're doing with compounding dividends?
The best place to find what we have going on is compoundingdividends.net. You can sign up for the newsletter there. We do have a free subscription. And then if you want to become a paid partner and get access to the entire portfolio and all of the companies in the watch list, the investable universe, the over 800 companies that I mentioned earlier, you can do that there. There is a Compounding Dividends Twitter account. That's Compounding W. You can find me there as well. It's TJ_Terwilliger. Those are probably the best places to find us and keep track of what's going on.
And he's very active on Twitter. As someone who follows and interacts with TJ, tries to keep up with him on a daily basis. He's very active on Twitter, and he posts a lot of great stuff. So it's definitely worth your mentioning, your following. The blog posts are great as well. The subscription. I was actually just reading one he wrote about a breakdown of REITs earlier today, and fascinating. Lots of great info in there. So it's well worth your time for sure. So TJ, thank you very much for joining us today. This was a lot of fun, and I hope you have a great rest of your day. And thanks for joining me.
Thanks for having me, Dave. Really enjoyed it.
You're welcome. All right. All right. Well, that, folks, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.